in the funding world, and really took everybody else's question and articulated in a way that people felt like, wow, that was a great evening, great talk. So we asked him to come back again, and we're really grateful you're here.
Absolutely,
So
thank you.
please talk about your book, and also just have an open dialogue about myth and the truth about funding.
Absolutely, and as you may remember from the last time I did this, one of the things that we did was we give people a chance to pass in their questions
Yeah.
and things like that. Can we do that again?
Sure, let me get the little card,
Exactly.
and in the meantime you could just
Precisely, I'll have plenty of
Yeah.
time to
Okay.
pimp the book and whatnot. While
All right, thank you, Chris.
Thank you. So thank you very much, everyone. Actually, I don't know where I'm supposed to look because there's cameras and things everywhere. For inviting me here today. So just a little bit about myself. My background is I've been in the startup and high-tech entrepreneurship world since 1995, which may be the year some of you were born, I don't know. But it's been a fantastic ride, and one of the things that struck me when I first entered that world is just how difficult it is sometimes to learn about how things actually work. When I first started, and I think I started fundraising for my first company in 1999, it was a completely different landscape. There were venture capital firms along Sand Hill Road, but they were just starting to get websites. And angel investors, you kind of had to go by word of mouth. It's almost like you need to find someone on a corner with a jacket and a bunch of watches or something, because there was no official resources for this. And since then, the world has changed completely. We have wonderful things like AngelList, for example, which make it very possible to connect with investors and see what they've been doing. We have people who blog and talk about this. And so there's a lot of wonderful information. You guys probably are far more well educated about fundraising than I was when I started raising money for my first company. But that being said, it's still really important, I think, to pull back the curtains and get an understanding of how funding actually works and what's actually going on inside the minds of the various potential investors you're talking with. Because as those of you who are marketers or salespeople know, the most important thing in order to gain a sale or to convince someone of something is to be able to put yourself into their mindset. So what I'm going to do today is I'm going to do a number of different things. One is to sort of talk generally about the investor mindset and how they're thinking about it, and maybe about some of the differences between angels and venture capitalists, because most of you are probably trying to decide which group to raise money from. And the other thing, as you probably heard me reference as I was talking to Ari, is we're going to get you guys little index cards so you can ask all of your various questions. One of the things that I like to do is to get people to be able to ask their questions at any time and just pass them forward, so that I can stitch them together into a coherent narrative and sort of tell an overall story about fundraising, while at the same time making sure I'm actually answering the questions that you find most relevant. So before we do that, I will take a moment to promote the book. I actually forced the publisher to print these cards up, because I said if I'm going to go around giving talks and telling people about the book, I don't want to tell people the same thing every time. And in fact, I heard that Thomas Wilson, the actor who plays Biff in Back to the Future, actually has a specific card just for this purpose. So he hands it to people, and it has questions and answers like, do you know Michael J? Are you Michael J. Fox fans? Yes, he's a really great guy, but I don't see him that often. Do people recognize you all the time? Yes, all the time. And so on and so forth. So I thought, this is going to be my Thomas F. Wilson card. So The Alliance is a book that's about managing talent in networked age, and it's particularly important for people like yourselves who are going to be leaders of your organization. Especially early on, you probably don't think too much about how you manage your people. You're just basically trying to get people, any people, especially those who will work for free. But as you get further along, you have more success and you build your business, you're going to need to grow your team. And at a certain point, you'll no longer be able to count on just everyone being someone that you know personally, or everyone being someone that you see 8, 9, 15, 20 hours a day, day after day. And so the Alliance is all about how do you actually structure the relationships that you have with your employees so that they're going to be mutually beneficial, and so that you'll be able to continue to attract entrepreneurial employees and people who are really going to be full of energy and be able to drive your business forward, even after you've gotten to be a big, successful company and not everyone can spend quality one-on-one time with you, the CEO. So The Alliance, especially if you are, wonderful book, great Christmas gift, the holidays are coming up. friends of yours maybe at various companies. So anyways, I do have these cards up here, so I'll be happy to give them out because, again, I didn't pay for them. So, you guys all have papers in your hands now. What you should feel free to do is at any point in time, go ahead and write down a question that you have. Any question, just pass it to the front. We'll slowly gather them up, and this will be a good repository of questions for me. In order to give you time to think of these wonderful questions and ask them, I'll start off by talking more broadly about investors and the investor mindset, and then that'll give you time to answer the questions, then we'll switch over to the Q&A.
Anybody needs a pen?
Pink one. Pink one.
All right, so the first thing I want you guys to know about the investor mindset is this. You probably think, wow, I really need investors. I'm desperate for investors. I need them to say yes, and these beings sitting on high and making decisions that determine whether or not my company is going to succeed. And what's interesting is actually investors need entrepreneurs, especially venture capitalists. Their job is to write checks. And admittedly, it seems strange that it's their job to write checks, but it is their job to write checks. And investors especially are becoming more and more focused on how do I convince entrepreneurs that I'm the right person to work with. I talk with a number of venture capital firms all the time. The good news is there's been a lot of change. Companies like Andreessen Horowitz have sprung up and been very entrepreneur friendly, both in terms of how they deal with entrepreneurs as well as providing a lot of support. And the other venture capital firms in Silicon Valley are catching up and doing the same. And people understand now that if you want to attract entrepreneurs, it's not just good enough to say, we have a lot of money. You need to be like First Round and put out the first round review and say, well, I'm going to add value by telling you how our companies do it. Or you need to be somebody like Andreessen Horowitz and have people who are actual world-leading experts be able to give that advice to the entrepreneurs when they actually become investments. So the first thing to remember is, don't feel to yourself that you need the investors. Of course you do. But they need you just as much. And you need to keep that in mind and understand that's a mutual relationship, and that'll be the first thing that you need to do to get off on a good foot. The second is to understand what the motivations of the investors are, and they're going to differ quite a bit. If you consider an angel investor, somebody like me who tends to invest smaller amounts of money, typically their own money, they of course want to make money. Everyone wants to make money. There's nobody who says, I have too much money, I just want to give it away. Well, I mean, there are people who give it away as philanthropists, but not just randomly to people on the streets. So they do want to make money, but usually the angel investments they make are not going to significantly change the amount of money they make, even if those investments are successful. Rarely it might happen if you were the first investor in Facebook, for example. There's Stanford professors who happened to be around when Larry and Sergey at Google needed to buy some extra servers, and they wrote him a check for $2,500 to buy a couple of servers, and lo and behold, he's like, well, that's taking care of my family and their descendants forever. But for the most part, that doesn't happen. And so angel investors are investing in your companies because they've probably been successful. They don't actually have the stomach to go out and start another company because they know just how hard it is. But they still want to be in the game. This is true for entrepreneurs as well. I met with an entrepreneur the other day who was, I think, employee number 3 at eBay. If you're employee number 3 at eBay, you're probably going to do pretty well financially. So you don't need to start a company or do anything anymore. In fact, just kick back and enjoy yourself. But people in Silicon Valley want to feel like they're a part of what's going on in Silicon Valley, and the only ways to do that are to be an entrepreneur or to be an investor. So angel investors decide, I remember how hard it was to be an entrepreneur. I would like to stay involved and add value and be part of the fun. They turn to investing. And so a big part of what you're trying to do is to convince them not just that your business is something that is going to be successful, because that is important, but rather that you're someone that they're going to want to be associated with. You're someone that when they're at a party, they say, I'm working with so-and-so. And I met her when she was just starting out, and boy, she is just killing it now. And a lot of the non-economic benefits of being able to get involved, being able to help, being able to have a relationship, a personal relationship, are really important to angel investors. Because the other thing is, with angel investors, the way you get other investments and other entrepreneurs is through referrals from entrepreneurs. And so being somebody whom entrepreneurs like and respect and have gotten value from is critical to, and being invited to deals as opposed to just being brought in when somebody needs some dumb money. So angel investors, keep that in mind. You're really focused on developing a relationship. You want to emphasize some of the non-economic benefits while at the same time pointing out that they're going to make money with you. Venture capitalists, on the other hand, have a different set of problems. So venture capitalists have customers themselves. Entrepreneurs are their customers, but they also have limited partners. Venture capitalists don't invest their own money. I mean, some of it is their own money, about 5%. But 95% of it comes from Stanford or CalPERS or some rich family in Tennessee or something like that. It's a true story. There's rich families all over, and they put their money into these venture capital firms. And so what they need to do is twofold. They do need to deliver returns because those investors, those LPs, they don't care about being able to say, oh, I'm invested in Google or I'm invested in Facebook or anything like that. They just care about the amount of money that comes back. But above that, the dynamics of venture capital are that venture capital funds are raised on a per fund basis. So instead of there just being a giant pool of money that they're investing from, like an angel investor investing their own money, a venture capital firm has a specific fund. So somebody like Kleiner Perkins, for example, is up to like Kleiner Perkins 13 or something along those lines. Each fund is a separate legal entity, a separate pool of money that gets invested. And the only way you get from fund 13 to fund 14 is convincing those rich families in Tennessee and Stanford and Yale and all those other places that you're a good investor and they should entrust you with more money before they know how fund 13 turns out. That's the really tricky part. You have to start raising money for your next fund before it's necessarily clear how your last fund is going to do. And so a lot of what happens is venture capitalists, again, are trying to build a great relationship, are trying to deliver returns, but they're trying to make the kinds of investments that they can talk about to their limited partners and show promise, so that when it comes time to ask those limited partners for a $50 million check for the next fund, those limited partners say yes. So this is why you end up in the world of venture capital with people investing in a lot of deals that just kind of look like they're Silicon Valley deals. Yeah. Oh, don't you have something in mobile? Don't you have something in social networking? Well, gosh, and the LPs, by the way, invest in multiple venture capital firms, so they know what's going on. They can say, how come you've missed this particular hot area, or why aren't you doing more of this? And so venture capitalists are also looking to see if you fit into one of their investment theses. And those investment theses are driven in large part by what the limited partners are looking for. So a company, a venture capital firm may say, our investment thesis is enterprise software as a service. That would describe a company like Emergence. Or somebody else may say, our investment thesis is big data. I think IA is a company that focuses on big data. And so if you're going to pitch venture capitalists, the first thing you have to do is figure out, okay, how am I going to look on their slide when they're at their annual limited partner meeting talking about what they've done? Because if you don't fit into their style box, it doesn't matter how great you are. And if you're not something that they can put up and convince some rich family in Tennessee that's a good investment, they're going to have to actually think twice about it. Because ultimately, you may deliver great returns, but in the short run, what they need is something that allows them to raise their next fund. So those are all things I think to keep in mind. The final thing I like to say about investors, and with entrepreneurs it's hard because you want money. You want to get investors of any kind. It's hard to continue writing checks out of your own pocketbook and to sacrifice and to not go on vacation and all sorts of other things that are very difficult. But it's very tempting to just sort of say, wow, these investors are going to give me money. Well, money's green, I'll take it. And money is green, but the important fact is that you can't fire your investors. Everyone else that's involved in your startup, you can fire. You can fire employees, you can fire contractors, you can even fire co-founders, although it's generally pretty unpleasant. But you can't fire your investors without their agreement. Once somebody is, as they say, in the cap table, i.e. in the capitalization table of shareholders, they're in it for good unless they agree to be taken out. So I always tell people, with employees, you're thinking very carefully, is this somebody who's going to fit here? Is this somebody who's going to work well with everyone else? Is this somebody who I feel like is going to be a part of this going forward? and yet they'll turn around and spend 1/10, 100th the amount of time vetting the investors that they're talking to. He's like, well, they have money, right? Wrong, because the wrong investors can make your life very miserable, and you won't be able to do anything to get rid of them. So it is really important to sort of think about that in advance. So with that as a backdrop, I think high-level thoughts on the investor mindset and how this all works, I'd love to have people pass forward some of the various questions they have, and then I'll begin assembling them into a narrative. So anybody who has questions, feel free to pass them forward to any of the volunteers in the room. And again, I'll look at all. I promise to answer all of the questions, to answer them as openly and honestly as possible. But I may, again, work out the order in some way that I think makes the most sense to you guys from an organizational standpoint. Good. So this is a question about investing in people, not ideas. What are the expectations of investors 30 to 60, 90 days after you complete your round? These are good. I can start answering these while everyone else continues writing. Excellent. Oh, yes. Excellent. Very good. All right. This is a good question as well. I'll realize this later. So what I'm trying to do is to fit them into sort of the lifestyle. Okay. Yes. Okay, good. So this is early. So what I'm going to do is I'm going to organize these things to earlier in the process and later in the process, because I think that this really helps figure it out. Okay, great. And then I'll continue. It's sort of, I feel like I'm sort of like playing cards or something like that, laying the cards out and putting them in the right order. So I'm going to start answering the questions, and as they come up, just go ahead and put them here and I'll slot them in. So the first question is it better to get money earlier versus later? And does this differ between the particular kind of startup you have, software, hardware, medical device, what have you? So what I would say is this. I think that an obvious answer is that it always tends to be helpful to have money. But there are some ways in which having money can be dangerous. Let me outline them. The first is once you have money, it starts to get spent. You have people who have been working with you for free, essentially. They've been making sacrifices. Once they see that check has come in and there's money in the bank balance, they're going to want to get paid. And in many cases, you've racked up a bunch of bills and you're going to have to start sending that money out the door. Also, once you start paying people, it's really hard to stop paying them. Even though in theory it doesn't make a difference, in practical matters, people don't take kindly to you. You're paying them and then no longer paying them. And so as a result, money starts the clock ticking. So once you take in a slug of money from investors, they invested that money similar to the way that a gambler invests in calling in poker, or well, I'm not a gambler, so I don't know all this. But the point is, what I do know is they have to put some money in and they get to turn over the next card. And so the explicit reason investors are giving you money is to turn over the next card. And you better turn over a card and have some information for them, because just coming back to them later and saying, well, we've spent the money, what else do we know about the company? Not much. Very unlikely to get you more money after that. So again, money starts the clock ticking, and your goal once you start the clock ticking is to turn over a card and provide information, to take risk out of the equation that existed and to make it seem like it's less risky to make that investment. So what I often tell people is, you've probably heard the concept of the lean startup. Eric Ries, a friend of mine, had put this book out. Great book. You should buy it right after you buy mine. But the notion in the lean startup is that until you have product market fit, you shouldn't raise a large amount of money, because you don't actually know what you're going to do with that money. And to some extent, the longer you can bootstrap and the longer you can gather evidence, the longer you can generate traction, which we'll come back to in another question, the more confident you'll be in spending the money once it comes in. So I think a lot depends. There are times, and believe me, I've had entrepreneurs who just said, I can't live, I'm out of money, I'm broke. I need to raise money from investors now or give up. Guess what? Better to raise money than to give up, because at least that gives you a chance to turn over a few more cards. But in general, what I advise people to do is to get to the point where they would feel comfortable taking this to their grandmother and saying, Grandma, you know, obviously you need your money for your retirement and everything like this, but this is a really great opportunity. I want you to invest in it. By the way, deliberately, for my first company, I didn't raise any money from friends and family because I was like, I don't think I need to. And two, if this goes south, which I know 90% plus of ventures do, it makes for a very uncomfortable family reunion. So I'm not suggesting that you go get money from your grandmother. I'm just suggesting that you use that as a test for whether or not you feel comfortable actually doing this. Next question here is a venture capitalist fund's thesis disclosed to the public? Is it something I can find on their websites? Typically it will be. If they're smart, they're going to put information on it. You can also infer the thesis by looking at which companies they've actually invested in that are in their portfolio. But the smart VCs actually talk about this because if you're a venture capitalist and you're not Andreessen Horowitz or Sequoia or Greylock or one of these funds that is legendary and known to all, your ability to get entrepreneurs to take your money is greatly increased by having a very specific thesis. You can't say, hey, my XYZ firm is better than Sequoia. You shouldn't take Sequoia's money, you should take mine. But you can say, you know, Sequoia does a lot of things. All we do is what you do. And here's our track record. So smart VCs do put their thesis out there. Even if they don't put it on their website, because there's some venture capital firms which for god-awful reasons no longer have websites, just Twitter accounts. Makes no sense. Terrible. You can generally find interviews with the general partners and managing partners, and they'll generally talk about what they invest in. Every venture capitalist gets asked that question all the time, and sooner or later it gets on the record. Do VCs ever invest in convertible notes, or do they always insist on price rounds, and do they always insist on a board seat? So the short answer is venture capitalists certainly prefer to do a priced round and take a board seat, but that venture capitalists also prefer to make money and will do just about anything in order to make that money. I believe that there is an example of, for example, Quora going into Y Combinator, or all sorts of strange things where venture capitalist takes a board seat but doesn't make an investment but gets stock. There are all sorts of combinations that happen these days because there's a lot of things being tried out. In general, the reasons that there's a good reason why venture capitalists want to invest in a priced round and want to have a board seat. They want a priced round because ultimately they want to own a chunk of the company. And a convertible note, while it is convenient and quick, you're not in the cap table and you don't really know what you have. How do you value that for your LPs? How do you do an annual report on how much that investment is worth? It's just inconvenient for them. But they will sometimes do that. Like some of the venture firms invest in seed deals, and they'll just throw money into a convertible note alongside everyone else. They're actually leading the deal. They're like somebody who's buying one share of stock because they want to keep an eye on the company, and buying that one share helps them keep an eye on that company. Do they always insist on a board seat? No. You can basically negotiate anything. I've seen investments where there were no board seats taken by investors. But the reason it is relevant is that corporate governance as an investor is critical. I've seen instances where founders mysteriously set up entities in the Cayman Islands where funds were misappropriated, where funds were misspent, where things just got lost. And if you don't have corporate governance as a venture capitalist, there's not much you can do about it. Especially if you're just a convertible note holder, there's nothing you can do about it. Absolutely nothing. All you can do is wait until the note matures and then demand your money back, by which point in time there may be no money. So there's a reason why they want the board seats, and for most of you, it's not going to matter. I'm going to assume that if you're in this room, you're honest, you're not planning to set up a subsidiary in the Cayman Islands and funnel money there. But venture capitalists still need to protect themselves. People have said that investors invest in people, not ideas, yet researching pitch decks from companies that have raised money clearly seems to indicate they want to see a prototype and traction. Is this conflicting messaging, or is it kind of a pitch tailored for earlier seed stage? So there is a conflict, which is that investors invest in people, but they won't invest without traction product. And essentially you can think about people as being necessary but insufficient except in very rare cases. So the example I like to give is, imagine if Marc Andreessen decided that being a billionaire venture capitalist were boring and he wanted to start a new company. He went out and he said, oh, let me put together a pitch deck. No, he wouldn't bother even putting together a pitch. He'd tell people, I'm starting a new company. Who wants in? Put your application to be in now. I'll accept bribes. And people would give him money. But sadly, none of us in this room are Marc Andreessen. Maybe one of you is a future Marc Andreessen. I hope that's the case. And then when the time comes, you can employ that strategy. But for the most part, they're investing in people because if you invest in a company and it has bad people, it's never going to succeed, or very rarely going to succeed. There are, sadly, examples of this happening. But for the most part, it's not going to succeed. And so investing in bad people is just a bad investment in general. That being said, I think you've probably read a lot of stories recently about certain CEOs and their behavior and whatnot. You know, what I would say there is that those are probably bad people that I would not want to associate with, but they may not be bad people as far as building a company. And that in Silicon Valley, you might invest in a venture capitalist if there was enough traction and the company was good enough and the person had the integrity and would run the company honestly. They would invest in an alien that ate alien babies. They would just say, well, you know, the alien babies, they're not actually sentient, it's voluntary, you know, we don't judge their foreign culture. But I know that he, she, it, whatever it is, really runs a tight ship and has been hitting the numbers. So think about people in the perspective of, you know, reliable, able to actually raise more money and drive the business forward. The reason why you need to show prototype and traction is just sadly, there are so many companies being started and so many entrepreneurs out there raising money that investors can afford to wait until you have a prototype and traction. And they can just simply say, well, if they're a good entrepreneur, they'll find a way. They're not going to let a lack of money stop them. They're going to go out there and find a way to get the prototype done and get traction into the marketplace. Maybe they go to grandma, I don't know, but if they're not good enough to get it to that point, why should I, Mr. Investor or Mrs. Investor, actually bother to look? And so it's kind of unfair because you hear people say, oh yeah, we care about people, we care about people, we care about people. But except in the very rare case, they're going to want people and traction. People and traction. This is the perfect follow-up, which is why you put it. How much traction is traction? And the answer is it's going to vary for every investor and vary for every situation. I'll give you some general guidelines. Revenue traction is the easiest to measure. If you have people actually paying you money, then people are going to sit up and pay attention. And if you're doing a software style business where there's essentially no cost of goods sold, where it's almost all gross margin, you know, anytime, if your company has gotten to the $10,000 a month range, people are going to actually pay attention. That's okay. $10,000 a month, that's some actual money. And it's not enough to support the company forever, but it's an indication that you're moving in the right direction, and you know, hopefully it sort of starts looking like this. Once you start talking about companies which have different gross margins, it's a hardware company. You know, hardware companies don't have the same gross margin. Maybe you need $20,000 a month or $25,000 a month in sales. The worst is when you start talking about like an e-tailer or something like that, or God forbid, an online grocery store. Well, there, $10,000 a month in sales is nothing because the gross margin on that's like $100. So now you need like $1 million a month in sales for some of these things. So it's just going to be 10. And then there's other cases, maybe you're doing a biomedical device and your traction is you have a development contract with one of the big pharmaceutical companies and one of the big medical companies. That is a single customer and maybe you're not even getting money up front, but that would also be considered traction. Essentially, traction is just a shorthand for it looks like the dogs are eating the dog food and that there's real promise here, that you've encountered the market and that the market in general seems to like you. But those are some of the numbers that you talk about with traction. And then the hardest, of course, is when you don't have any revenue at all. When you have a service or product that's free for the conceivable future, and is it number of downloads? Is it daily active users? Is it the number of page views? It's hard to say. Ultimately, I would say my real guidance there is that, in my opinion, it's more important to show intensity of usage and love of product than it is to show sort of the mass adoption. An app, let's just take an app for example, because it's an easy example. If you have an app that's been downloaded 1 million times, that's pretty good. But the context really depends. If you download it 1 million times and daily active users is 100, that says this is never going to work. If on the other hand, you have an app that's been downloaded 10,000 times and daily active users is 9,000, that says, whoa, let's get these people some go-to-market help because this is something that people love. You can fix a lack of go-to-market a lot more easily than you can fix this product sucks. And so intensity of usage is probably the most important thing. And one of the things I always tell entrepreneurs to do is to create statistics and charts that show that intensity of usage, especially if it's rising over time. The biggest mistake I see people make is they create these charts that are like cumulative downloads. Like, that is useless, completely useless. A, because unless it looks like this, if it looks like this, then it's like the derivatives are actually more interesting to use like a mathematical thing. Like the first derivative of the number of downloads shows you, oh, this is the rate that it's going. The second derivative is even more interesting. Is it accelerating or is it decelerating? And so oftentimes investors are looking at the first or second derivative rather than that raw number. So you should always be doing the various rates and demonstrating the acceleration of adoption rather than just relying on an overall number. So here's a question. So let's assume that you've actually started the process and picked an investor. And somebody asks, what bad outcomes can happen if you pick bad angels if they have no board seat? What is the worst that can happen? Well, the absolute worst that can happen is that they can sue you, because this is America. Anyone can sue you at any time, even if the lawsuit is frivolous. And investors are smart, generally smart enough to know that if a company is operating under threat of lawsuit, no other investor will touch it. So they can essentially blackmail you. That's not a good thing. Now, I'm not saying that people are going to do that, but I've certainly seen blackmail happen before, whether it be a founder threatening to sue investors or an investor threatening to sue founders. And you just have to either wait them out and try to convince them otherwise, or pay them off. And I've seen payoffs happen. It's not pretty, but it happens. And you just don't want to do that. You don't want to take, just imagine, I have a bad investor. I'm going to have to buy him out at the amount he invested plus 100%, basically screwing over my other investors just to get rid of him. That doesn't feel very good, especially it's so hard to get the money to begin with. Other bad outcomes, they could refuse to sign paperwork. There are things that, there are consent forms and things that you need to gather, and they can just be obstructionist about that. They can threaten, they can make various noises, they can distract you by constantly bombarding you with questions. There are all sorts of reasons that they can be bad, but the nuclear option is they could sue you, which just basically kills your ability to raise any more money. Which is why, again, pick them very carefully. Employees can sue too, but it's usually more manageable. There's a really good body of employment law, and people can say, oh, these employees, they sue randomly, it's okay. That hasn't stopped companies like Snapchat, and et cetera, referenced earlier, from going ahead and growing like mad, despite having co-founders and other people suing them left and right, because people basically know how to deal with that. Assuming you've taken money, what are the real expectations that investors have 30, 60, 90 days after you've completed the round? The money's come in, we said we do X, now what? So most investors, even venture capitalists, are not going to expect information from you more than roughly on a monthly basis. They are going to want to see things like, okay, how much business did we close? How much money did we spend? The monthly revenue, the monthly burn, the monthly update is really important. And it's especially important because let's imagine that you don't give them updates, and then all of a sudden you come to them with bad news, because usually that's going to be the thing that forces you to go to them. What are they going to think? They're going to think, hey, this person just treated me like a mushroom, kept me in the dark, gave me nothing, and now that they need something, they're coming to me. This is the nature of the relationship, I guess. So that's not good. I believe very strongly in communicating with investors, and that means not surprising them. I often say, if you're in the process, by the way, I'll just refer to this, if you're in the process of raising money, one of the things I like to do is to actually maybe write like a quasi-newsletter that I send out to people who are interested, people who I've met with who might be investors in the future but haven't yet invested, as well as those who've already invested. So they continue to see the progress that you're making and that you're really communicative. Because what that tells them is, okay, they're really communicative to me now, they'll be communicative to me after I invest, and I'll be able to feel comfortable that this is someone I trust who's going to be open with me. In terms of the actual achievement of milestones, on the one hand, if you have like laid out month by month financials, they'll want to see how you're doing against the plan. But everyone understands that those financials are bullshit. They are. Never in history has some company carefully marched along the actual plan that was put forth in front of investors. It's always either wildly behind, wildly in front, varying all over the place. The only way a company actually marches up like that is if they're cooking the books. And in fact, if I had a company that was hitting their target exactly every time, I'd be like, maybe we should pay an accountant to go in and just check it out. That doesn't feel right. The expectation is essentially just that you will be able to tell the investors what are the really important things you're doing, and you'll be able to tell them what they can do to help you with them. Because from a board management standpoint and an investor management standpoint, they want to be helpful, and they honestly want to be helpful, but if you don't direct that helpfulness, their helpfulness will take the form of, hey, here's some other random company you should talk with, maybe you can work with them. Or, hey, I read this thing recently, have you thought about it? Things which, while not actively unhelpful per se, are going to waste your time, when you could have instead had them creating an introduction to this company or referring you to this person. So, homework, very, very important. All right, I'm going to take a moment now. I think I've got these. I'm going to work on the next set. These are blank. Okay, good. All right. Very quickly. And while I'm talking, feel free. I'm curious. Is this working for you guys? Is this kind of good answers?
Yes. Amazing.
Excellent.
Thank you.
All right. What kind of investors you're looking for? Spend on this. Okay. Yes, this is a good one. All right. Let me do it in this order. Okay, what is the best way to know what kind of investment you should be looking for? Are there specific milestones that angels, seed, VCs are looking for before your company they're interested in? So, I think that as I sort of mentioned, everyone's kind of looking for product. It's very rare that people will invest in just an idea, even the crazy people like me who invest very early stage. People want to see a product because there's just so much risk. If you think about the risks involved, they're generally people risks, product risks, market risks. And what you're trying to do is reduce those as much as possible. But that product risk and market risk are the critical risks. Like, that's why they say people, right? If you have bad people, if they don't have integrity, you're always going to fail. But even great people can't overcome a bad market and a bad product, no matter how hard they try, no matter how capable they are. So actually having a product that's into the marketplace that has some people paying for it or using it, that helps overcome both of those at once, which is why it's so critical. The difference between raising money from angels and seed and VCs is VCs have certain targets. They're going to want to deploy multiple millions of dollars in a Series A round financing. They're going to want to own a significant chunk of the company. It used to be they wanted to own at least a third of the company. Nowadays you can get by with less, especially if you're a hot company, but they still want some percentage ownership of the company. And so before they're going to deploy those millions of dollars, they're going to want to see strong evidence that there is a there. And usually the key with venture capitalists is you have a very clear idea of what that money's going to go to do. So for example, here are some ways that you could say, here's how we're going to use our money. Hey, we've established this traction in the marketplace. This Series A is to allow us to hire an A team to execute on the go-to-market. Hey, we've got this phenomenal adoption of our freemium product. This is to hire an engineering team to build out the premium products that are going to allow us to charge more money and increase our revenue or ARPU per customer by a factor of 10x. So knowing exactly what you're going to do with that money is probably the critical thing for VCs. For angels and seed, they kind of want to know what you're going to do, but they know what you're going to do. You're going to run the company for another 6 to 12 months and hopefully prove that you have something there. It's an excellent question. Why does it seem so difficult for women founders to raise venture capital, or is this just a perception? So it is more difficult, and there are a variety of reasons for that. The first is that most venture capitalists are men, and specifically most venture capitalists are either white or East Asian men. And more specifically, most venture capitalists are either white or East Asian men who receive degrees from a list of approximately 3 schools. I remember a statistic I checked some time back that said that approximately 35% of all venture capital general partners graduated from Harvard Business School. That's pretty crazy, right? This is one school, and it represents a third of an entire industry? That's kind of weird. It happens to be the school I graduated from, so I was like, oh, that's a good thing. But, these folks are coming out of a very particular background. And there is another question later on that talks about the personal interest and background of a VC. And as we said, you're saying people say it's a people business. I'm investing in people. I'm going to invest in people I feel like I have a good connection with, I have a good relationship with. And people naturally feel more connected to people who are like them, even though they don't realize this. A fascinating story I like to tell is I was at an event, it shall remain nameless, where I was with a bunch of Silicon Valley power players, and then I was there. I have no idea why. And the topic of Silicon Valley as a meritocracy came up. You guys may have heard this term going around. And all these extremely wealthy, powerful white men began to say, oh, of course it's a perfect meritocracy. I've never seen any discrimination in Silicon Valley. I know we're not perfect, but we're certainly better than everywhere else. And if people work hard and they're smart, good things happen in Silicon Valley. That's why it's a meritocracy. And there was a woman in the room, and she was of Middle Eastern descent. And I looked across the room at her, and she's like, what are you gonna do? But it's true. And so, for the most part, venture capitalists come from a particular demographic, and that demographic perceives Silicon Valley as a meritocracy. And that's it. Let's put it this way. If you're at the top of the heap, then you like to believe that the heap is based on merit. Not that it happened to be that you went to the right schools and had the right background, your parents were wealthy, and maybe your father was a venture capitalist, and your grandfather was a venture capitalist, right? So that's why it's an issue. The other issue is that one of the things, for better or for worse, that investors are judging entrepreneurs on is their ability to raise more money and convince other people to give them money and give them business and so on and so forth. And that's one of the reasons why there's this sort of bias towards what I call these brash entrepreneurs. They're in the headlines, right? They love the spotlight. One might argue they're megalomaniacal. But those are the folks who will just grab on and just not stop until they get what they want. That's probably not a good thing in their personal lives, and that's probably not a good thing for hanging out with them. But remember, the venture capitalists are thinking, what's going to look good to the LPs, and am I going to have an exit that's going to let me buy another car, another fleet of cars, sometimes. So as a result, this is the sort of the Sheryl Sandberg lean in phenomenon. For whatever reason, in this particular country, not all women feel comfortable saying, I am the greatest. I am killing it constantly. Nobody can stop me. We have the greatest team in the world. We have the greatest product in the world. I'm the greatest person in the world. Roughly translated, that's often what you hear entrepreneurs say. And as a result, those people who don't see past that sort of pattern matching and just say, I'm looking for a super arrogant pair of Stanford computer science graduates, one white, one Asian, or maybe both white, or maybe both Asian, we'll deal with it, men, of course, who I see at the right parties. And that's unfair, and that's not really good, and that's a bad thing. And what I tell people is to use an expression that I borrowed from Cal Newport, who in turn borrowed it from Steve Martin, who is a great writer and also happens to be a comedian of some note, as I understand. And what Steve Martin says is, be so good they can't ignore you. Which kind of sucks, because it's putting the onus on, wait, you're telling me that the world is unfair, and the answer is, I gotta try harder? Come on, that doesn't feel very good. But at the end of the day, things like traction and numbers are impossible to argue with. And if you look at, there are many successful women founders now, and if you look at the fact that they were able to raise money, I actually have documents I need to sign today at some point for one of my seed stage investments that's raising a Series A. It's a company that's done fairly well in the marketplace and has got a lot of great traction and a lot of great validation. It's got, like, for example, the top business partner it could possibly have. Its CEO is now an investor on the advisory board. That's good stuff. And they're raising, I think it's going to end up being like a $5 million Series A and a $20 million pre-money valuation. And this was done, I got into the seed deal when it was like a $4 million pre-money or something like that. And this is a company that's founded by a woman. It's actually based on the East Coast. But she's got the numbers. She's got the results. She's got the relationships. People are crazy not to invest. And so ultimately, it's not about being a woman or not being a woman. I mean, it's a handicap, unfortunately, because of the institutional bias in the system. But you can, it's a handicap that is easily overcome. As I mentioned, you know, gender dubious alien that eats babies could get money in Silicon Valley if it actually delivered enough traction. That sounds like a backhanded compliment, so we'll leave it at that. What is most important for a VC firm? How long does a VC firm or fund normally last? The most important thing for a VC firm in the long run is not its history, but rather that it delivers returns. And I will not name names, but you can see that there are certain very storied, very well-known venture capital firms that today are running into various problems. And you can tell that they're running into problems because their general partners are all leaving, or the general partners aren't involved in the newest fund, or what have you. And if you look at each of those, what generally happened is that firm was successful in the past, but its previous fund, maybe it raised a very large fund or what have you, didn't deliver returns. And if you don't deliver returns, that's it, done. The LPs, like I said, are not in it to sound cool at cocktail parties. They're in it to make money for their university or what have you. And a VC firm or fund, a fund itself normally lasts 10 years. It's raised for 10 years, so it's usually going to spend the first 5 years or so making initial investments and the remaining 5 years sort of managing out those investments with the goal of having exited those investments or written them off by the end of 10 years. And so you'll see venture capital firms have overlapping funds. They might raise a fund every 3 to 4 years so that you have a couple of funds going at any given time, but only one that's sort of in the super active investment phase. Venture firms can last a long time. Some firms, like Sutter Hill, were founded in the 1960s. So there are firms that are celebrating their 50th or 60th anniversaries, maybe even more. I don't have the knowledge to know. Some may be even older than that. So they certainly can last a long time, but only if they're able to manage the generational change of passing the torch from the founding partners to a new generation, to a new generation, to a new generation. And one of the interesting things that you can do if you're going to be in the game for a long time is to sort of look at the firms and see their young associates or principals who they've brought on, and sort of figure out which of those are going to become the next generation at that firm. Because if you can begin developing relationships with them now, that's actually extremely beneficial 5-10 years down the line. It's a very long game to play, but if you're planning to be around for a while, it's probably a good one. How do you tell if the investor is wrong or not? So I'm going to assume that this is, how do you tell the investor is wrong in their opinions, not just wrong in general? I think you can probably tell if an investor is wrong in general just by, you know, how you would normally be able to tell if somebody's a psychopath or serial killer. You know, they look you in the eye in a strange way, and they eat human beings and stuff like that. How do you tell if an investor is wrong for you? A lot of it is going to end up being based on feel, but it really comes down to, are they trying to push you to do things that in the end you just don't agree with or don't feel comfortable with? Now, an investor should try to, like a coach, should try to stretch you, should try to say, hey, you know, here's some stretch goals, or here's some things I'd like to see you do to get outside your comfort zone. But an investor shouldn't be saying things like, well, I know technically this is illegal, but, or anything along those lines. It's usually never going to be that blatant. But they may be saying, oh, you should go after this market, and you know that market is completely wrong. Or they may say, you really should be spending all your money on this. And it doesn't feel like it's the right thing to do. Because the thing is, there's no reward for following instructions. There's only a reward for delivering results. So if the investors told you X and Y, you did X and Y, and things didn't work out, you can't go back to them and say, but you told me to do it. They would say, well, you should have been smart enough to ignore me. My God, I'm just an investor. I don't know what's going on. So if an investor could very well be wrong, they're going to tend to express their opinions very forcefully. But there's an expression, strong opinions weakly held. And you can probably tell this if you've dealt with them over the course of 6 months. Oftentimes the opinions they hold 6 months later are not the same ones they held 6 months earlier. So investors are wrong all the time. You as an entrepreneur are called upon to develop your own knowledge and your own model for the world. And that's the whole reason they're investing in you. Because if they had the perfect idea of what to do themselves, they would just do that and make a lot of money. Mark Zuckerberg has more money than any venture capitalist in the business. even the ones who are enormously successful. Mark Zuckerberg is worth more than all of them. From a financial standpoint, I'm not going to make any judgment on this. How much do personal interests and background as a VC matter? For example, are you more likely to invest in a family tech company because you're a father of two? So, a couple of interesting things there. I think that the personal interests and background of the venture capitalists matter. I think your knowledge of those personal interests and background send a strong signal that you don't just see them as a cash register, but rather as somebody who has specific expertise and ability to help you. And whether or not that's actually true, that is still the impression you want to convey. Because I have an expression I like to tell people, which is, if I can't figure out why you want me as an investor, I have to assume that one of us is dumb. Either you're dumb for wanting me, or I'm dumb because there's no reason for me to be in this deal, and apparently no one else wants to be in it, and so you're desperate enough to come to me. So I think it's really important to see how those personal interests and background line up. I think that the mechanism is not that I'm going to invest in a family tech company because I'm a father of two. Good research, by the way. The answer is I will have more knowledge of whether or not whether I think something will be successful because I'm a father of two and I have direct experience. Venture capitalists love to invest in things they have direct experience in, which is why I think people have noted that there's been this huge wave of Uber for everything, because the idea of instant gratification, even if it's more costly, is very appealing to venture capitalists who are less price sensitive and more time sensitive. That's not the entire world, by the way, but that is their world. And so they're like, oh, wow, butler service, that sounds really cool, I've always wanted a butler. There's no real market for that. There have been examples of this in the past. In the first internet boom, Jim Clark, brilliant entrepreneur, founded Silicon Graphics, Netscape, Healthion, done all these amazing things. He decided that what the Valley really needed was a startup he called My CFO. He said, you know what, me, my friends, all of us were like, we need our own CFOs. That's got to be a huge market. Everyone needs their own CFO. Let's create a company, funnel $100 million into it, and hire a big staff so that we can offer personal CFOs. Well, guess what? The number of people who need a personal CFO is extremely low. And there's an entire financial services industry that is already set up with investment advisors and accountants and tax people and everything like that. They don't need a CFO to tell them what to do. In fact, who in their right mind pays someone $300,000 a year just to be the CFO of their personal finances? They need an awful lot of money. So that company, needless to say, didn't work out the way that he intended, despite being one of the great entrepreneurs of all time. Ended up getting sold to some private wealth management company at fire sale prices later on. So investors do invest based on their own passions, their own interests. But at the end of the day, while sometimes they'll just let themselves get carried away, and you can take advantage of that, the mechanism is just the familiarity. It's not like I want to support this person because they're like me. It's more like, oh, I understand this product, I understand this market better because they're like me, and therefore I'm interested in investing. Okay, well, this one's got front and back. Very cool. Let's see. Yes. Question. This is a good one. If you can speak to it, what are the communications expectations for founder to investors after raising money on an angel syndicate? I.e., is it okay to solicit help when it involves little of their time? And how have you seen this done well? I do think that even if they are just quote-unquote an angel syndicate investor, they still have some money in you, and you might as well try to get something out of them. I think that creating an investor newsletter that's just for investors, that details what's been going on at the company, at least on a monthly basis, is extremely helpful, and putting something in that in terms of things you can help us with makes a lot of sense. I've seen a lot of entrepreneurs take this on as best practice. This might be because I tell them that they should, so maybe my view of it is biased, but I do see a lot of them saying, hey, here's the update, here's what we think you can help us with, is there anything else you think we should be doing? And people, even if they don't ever reply to that email, they at least feel like they're being treated with respect and as a valued member of the team. So I think that it makes a lot of sense, and I have absolutely seen this done pretty well. The best entrepreneurs will do this by sending something at least on a monthly basis But even something that comes on a more infrequent basis is still useful as long as it doesn't bring any wild surprises like, well, I know you thought of us as a software company, but we really feel like our gourmet French fry pivot is going to work well. You're like, what happened? Huh? Okay, this is an excellent question. We're thinking of raising $1 million. One approach is getting $50,000 from each of 20 angels, and another approach is getting $1 million from a single venture capitalist. What are some considerations you would think through in approaching this? So, I definitely have a bias here, and it's even not a self-serving bias, sadly, which is that if you can choose between getting $1 million from 20 people or $1 million from one person, you should get $1 million from one person. It's a little counterintuitive, but let me explain. Each of those 20 people has put in $50,000. Yes, okay, maybe they can help you now and you're getting great people on board. The problem is, when something goes wrong, and inevitably something goes wrong, and you need more money, it's hard to actually get more out of them. Each of them's like, 50K is gone. Oh well, I guess I'll take a smaller vacation this year. And they don't feel responsible. And they don't want to step up themselves because they're like, why should I let all these other guys or gals freeload off of me? In contrast, if you have $1 million from a single VC, it's like the old joke about the bank. You owe the bank $100, you have a problem. You owe the bank $1 million, the bank has a problem. The investor who's put $1 million into you, and usually if that's the case, they're going to be a venture capitalist. I'll walk you through their psychology. One, they don't want to lose that money. Even though it should be considered sunk costs, they don't want to lose that money. And they'll generally put more money in. I've seen investors put more money into deals even though I'd be like, what are you doing? Are you insane? Why are you doing this? Sunk cost. Doesn't matter. People still do this. The second is the dynamics. Every investor is all venture capitalists are typically part of an overall partnership group. And they did the investment in your company, and they persuaded all the rest of the parties, this one's going to be good. This one's one of mine. I'm taking credit for it if it succeeds. Well, guess what? If you ever noticed, from Fund 13 to Fund 14, sometimes some of the partners don't show up in Fund 14. Now, sometimes that's because they're now 75 and they want to spend more time on their yacht or whatever. But a lot of times it's, hey, you know what, that last fund, you didn't pull your weight. All the deals that you brought in sucked. And you made a bunch of money off of my back. I won't have you anymore. And so, they don't want to look bad in front of their partners. They don't want their partners to be thinking, well, Chris picked a bunch of dogs. We should go behind his back and cut him out of the next fund. And so they want that deal to succeed for partnership reasons as well. And so as a result, they have a lot more reasons, they're a lot more on the hook, and you probably, because you've concentrated your efforts on that single person, developed a much stronger relationship. And they're closer to the issue, they've been hearing regular updates and actually paying attention. And so when you say, I have a plan for what I'm going to do with the additional money you give me, they're more likely to believe you. Now, that doesn't stop you from doing a hybrid approach, right? So if you raised $500,000 from a single investor and then $50,000 each from another 10, you have the reach of those additional 10, but you have someone on the hook who then has some of the moral force to strong arm the other people into chipping in more money. Now, I've invested in various syndicates and deals and things like that. There have been times when I was like, I really don't want to put more money into this deal. I don't think it's a good investment. But I've agreed to be part of this syndicate. The lead investor is putting in more money. And if the lead investor decides that you can't count on Chris when times are tough, guess who's not getting invited into the next syndicate? So having a syndicate lead, somebody who has that moral force and holds that arm-twisting advantage over the other investors, can allow you to get more money out of those investors as well. So I always advise people, if they have the opportunity to, do that. It's more trouble in some ways because they may want a board seat, they have more control, they're going to want to be more involved versus you're raising from 20 people who put in $50K each. If you never talk to them again, they're probably, at some point in time they'll wonder, hey, what happened with that investment? But they aren't going to think about it that much. But when times are tough, when things go wrong, and again, things always go wrong, you'll really want to have someone on the hook. So that is an excellent question. Are there other questions? I see people holding papers in their hands, or they may be notes. I don't know.
Yeah.
Doodling. fair enough. And again, I do not, there's no part of my ego attached to like lasting all the way through to 2:30. So I'm happy to answer spoken questions as well if anything comes up. If you've been part of a successful exit or multiple, but not as a founder, should you mention it prominently? Also, if your school is a big name, say MIT, associated with successful entrepreneurs, should you mention it even if you've been out of school for a while? It seems sort of weird and obnoxious. All right, so when it comes to raising money, your friends are never going to find out that you've been running around talking about how great you are. Your mom's not going to say, but don't get such a big head. Nobody's ever going to see it other than the investors.
Oh my God.
So take credit for everything that you actually deserve credit for. Now, don't take credit for things that you haven't actually done, because some investors actually check. I actually check these things. The person's like, oh, I'm a founder of that company. I'm like, oh, who are the other founders? So, was this person founded? No, of course not. They're a consultant. What are they talking about? So that, wow. No problem.
Technically, sure.
So that happens. So don't put down anything false. But for goodness sakes, if you've been a part of multiple successful exits, not as a founder, you've still learned a ton about what it takes to build a successful company. And again, so obviously, first choice of an investor is to found a successful serial entrepreneur who's made billions of dollars for other investors. Second choice is to found someone who hasn't done that before, but has been a part of making billions of dollars for investors. That's better than somebody who has never founded a billion-dollar company and also has never been associated with any successful companies. Right? Take credit for that. And your school, you went to MIT, hey, you know what? Even though that happened decades ago, there's still things you can do. You can reach out to alumni. You understand. You can reach out to faculty. There's all sorts of advantages that you have as an alumnus of that school, even if it was a long time ago. I just came back from my 20th reunion at Stanford. Am I going to say, that was so long ago, that's younger than some of the entrepreneurs I know? I'm not going to mention that anymore. No, of course not. If there's people who graduated from Stanford, if I can somehow leverage the power of the school's name, so much more benefit for me. So don't worry about it. When it comes to raising money, all that matters is that in the end you raise the money. And again, your friends, look, when it comes to like, if you're going to a party with your friends, if you go to a party with your friends and you say, hey, they say, what have you been up to? And you say, well, let me pull out this deck and let me talk to you about the traction we've been getting and how we've been killing it. You'd be like the biggest a-hole in the world. That's just ridiculous. You wouldn't do that. Instead, you would say, yeah, things are going pretty well. Got something pretty exciting here. Do you happen to know anybody who does this or who does this? And that's perfectly socially acceptable. But when it comes to pitching to investors, it is perfectly acceptable to talk about all the things that you've done that have been successful and all the things that make you capable, more than capable, make you a great candidate for becoming an extremely successful founder. So with that, I'll open up to any verbal questions that people might have, or we can sort of finish up because I know we're only scheduled to go to 2:30 and there's time for sort of one-on-one chats and other things like that.
Totally up to you.
All right. Any questions that people did not get a chance to ask? Be happy to answer them. I'll count to 3. 1. There we go.
I would like to learn more about Wasabi Ventures and what makes it different.
Excellent. So look at that.
Thought you'd never
Straight
ask.
person.
Are they all
So-
Harvard MBAs?
So an excellent question. I'll tell you the story very quickly. Wasabi Ventures was established ultimately because my business partner and I were really big fans of sushi, and I thought it was a cool name.
That's a cool name.
Many years ago, back in 2000, I met a guy named Tom Kugler. I hired him as the VP of sales for my very first company. He had come from another company called Right Now Technologies, went public, very successful CRM company, eventually bought, I think, by Oracle or Salesforce.
Yes.
I can't remember.
Oracle.
Oracle. There you go. And he worked with me on my first startup, which sadly did not enrich me enormously, but was still a great learning experience. And then we stayed in touch ever since. And we would do things because we're crazy entrepreneurial guys, and like we built a company together, built an online service together, and sold it to someone for some money. Like, hey, this is great. And we're like, what should we do with this money? I don't know. Well, we have to pay taxes on it if we take it out of this entity. Yeah, we would. Maybe we should invest it. Yeah, sure, why not? And so that's how we ended up starting to do these kinds of investments. And we blundered around quite a bit doing different things. And this is one of those great things about the world of entrepreneurship. There's no there's no one set way to do things. And one of the best ways to learn is just go around making mistakes. So we just went around making all kinds of mistakes. We try things, all the things that I think people who are investors or people who are coming to this think, wow, that should work, without realizing that they never work. So for example, we were like, well, why don't we build a bunch of random companies ourselves and just launch them into the marketplace and see how that works. And we could build like a company a month, that would be great. Started doing that, and lo and behold, that doesn't work really well. They all take so much time, and so few of them succeed, and meanwhile, nobody's actually paying attention to them because it's just us and a bunch of random freelancers, and oh, how much money do we spend on that? I don't even know. So we're like, okay, that was not a good idea. I mean, we even made like Flash games and stuff like that, all sorts of crazy stuff. We didn't necessarily think we were going to be an investment vehicle per se, which is like, we're going to do stuff with the money. Gradually over time, what we realized is that the way that we added the most value to entrepreneurs was in being what I call an artisanal incubator. And what I mean by that is that we tend to work very closely with a very small number of entrepreneurs. We're taking wild risks. In some cases, we're developing relationships with entrepreneurs before they even have an idea. And what we do is we teach classes at certain universities and have these online courses as well. They're all free. Not that I think we could charge for them. Maybe we could. And the idea is just to identify people that we think really have what it takes to do something interesting. Some of them are college students. Some of them have been out working for a long time. It's all across the board. And we pick the very few the few that we believe in the most, and we try to work with them to come up with an idea that we think makes sense, and then for them to be the entrepreneur leading the charge to building the company. Because having investors who think that they can build companies is a really bad idea. As an investor, you can help, you can even play an operational role, but you need someone whose sole focus is this company, the entrepreneur, the magic, I'm going to make stuff happen. So we've been doing this for a while. We have a couple of companies that have sprung out from this with some entrepreneurs of varying ages and backgrounds who are doing this. And we give them a little bit of money, and then we help them raise a little bit of money from other investors in order to make this successful. And the reason I like doing what we're doing is it puts the emphasis on the things that I really enjoy the most, which is mentorship and coaching. And it allows us to play in a market that other people aren't playing in. I'm very good friends with people at various firms up and down Sand Hill Road. Am I going, I don't have the money to do it, but even if I did have the money, would I go and try to argue with an entrepreneur and say, you should take my money instead of Reed's? You really want my money, not Reed's money, not Greylock money. Those guys don't actually do it. No, that's crazy. It would make no sense. So what I do instead is I try to help and work with people who, before they get to that stage. So I don't want to compete with my friends. So anyway, that's the story there.
Hi.
Yes.
Thanks so much for coming today.
My pleasure.
I really enjoyed hearing you. I'm definitely going to buy your book.
Excellent. I love it. See? More royalties in my pocket.
And I'm going to write you a review too, so.
Oh, thank you. You know exactly what we want as authors.
That's true, yeah.
You must have been one yourself.
Well, I have an app, so I like when people write reviews.
There you go.
on my app.
Yes, write reviews, 5-star reviews, please.
I agree with you. I was for a long time really uncertain about my product, and then I just started developing it. I have a creative and design background, so I just started designing, and getting it to a place where it was finally ready for development. Develop my product, I call it a prototype,
Right.
but it's really not. It's really pretty amazing. Launched my app,
Yep.
stopped everything I was doing, and raised $40,000. And then I came here.
Got it.
I've been all over the continent. In my mind, the way that I'm thinking of my own personal timeline,
Mhm.
aligned with my business, to raise 40 and then to build out, certain features, find that market traction,
Right.
marketing, all the other things that I've tried to allocate that money for. The next amount, in my opinion, is more of like $100,000, right? Which then I would kind of go to this level and then safely go, and kind of this
Right.
incremental, stabilized success, right? Instead of raising 40,000 and then thinking, oh, it's $1 million next time, or
Right.
it's 2 or 3.
Right.
I love that, right? But I'm
Good.
actually kind of afraid of that number.
Yes.
Because, I think that when you're not learning and growing, right? And I think learning and growing early from your business is really important.
Yeah.
So after raising 40, is it more, are you agreeing with me?
So I'm partially agreeing with you,
Right.
and I'll sort of talk about it. So there are a couple of things that are interspersed, and I'll try to cover each of them. The first is sort of the amount of money that you raise, and there are certain, and again, these evolve over time. It's almost like in the space program, they have these things called Lagrange points, which are like stable orbits in front of and behind the moon where you could theoretically situate space colonies. Well, the investment world sort of has those as well. And there's certain sort of sweet spots for amount of money being raised. And 40,000 is sort of like the classic friends and family getting off the ground kind of thing. That's a good amount. From there, for professional investors, or serious investors, the sweet spot, the next sweet spot tends to be in that 250 to 500,000 range. And the reason is raising 100,000 doesn't get you much more than what you're already doing at 40.
Very true.
And what I generally tell people is, tell people that you're raising 250,000 because that's a credible amount. Hope that it then gets up to 500,000. Because if you say you're raising 500,000, you have 400,000, you can't actually close it. People are like, well, you said 500,000, there's only 400,000, you can't do it. No. Here's we're looking for 250. Oh, look, everyone was so enthusiastic. We're up to 400,000 now. That's great. That's fantastic. The next level up from that, there are people who are raising like $1 million, $2 million, and this absolutely is possible. I tend to believe that's suboptimal. I tend to believe that once you've gotten that 250 to 500, if you raise 500 and then you go out to raise $1 million, that's probably a sign that sort of growth is stalled out and you can't actually get a real venture capitalist to give you a Series A round. You should still do that, right? Better to get some money than no money. But really the proper progression in my mind is you raise like 250 to 500,000, then you really prove it out, and then you can raise a couple million from a venture capitalist.
And as long as you do a lot with very little.
Right.
It's really, you're proving your track record along the way.
Exactly.
Right?
Now, the thing that I think you've got absolutely right is you have to be careful about taking too much money. And the reason, there are all sorts of reasons for that. But my favorite reason is that too much money can trap you as an entrepreneur. And this has actually happened to me. My first company I mentioned was not ultimately successful. But I was the founder of the company. I couldn't leave. I had to keep fighting for my investors as long as there was any chance I could get them money, even if it was no longer economically rational for me to do so. Now, there are some founders who are just like, you know what, this hasn't worked out. Sorry, guys. Those are founders who typically struggle to get money the next time because it's a pattern. It's like, wait a minute, you walk down your investors once, why am I going to be different? It's the same thing as, you cheated on your spouse with me, but surely once we get married, you're going to be completely faithful. It doesn't make any sense. So raising too much money can trap you, and that's why it's good to really be sure before you take in a significant amount. Taking in $250,000, $500,000, that's not going to tie you down for 5 years. But taking in a couple $1 million will.
Thank you.
Excellent.
Thanks.
All right, one last question.
So this is a software versus hardware
Yes.
question. So I'm Minda Guha, I'm CEO of Peak Focus, and we're building elegant watches for anyone who wants or needs health monitoring with
Interesting.
style, like
Yeah.
seniors
Yes, I
and
like that.
patients. And so I hear about this taking in too much money thing, but hardware is a lot of money.
It is really hard.
And the margins are
Yeah.
smaller than with software.
Yeah, and what I've seen a lot in the hardware world, this is not any sort of particularly insightful advice, but in the hardware world, a lot of people have turned to crowdfunding. Because a great example is a company that I was an advisor for and eventually invested in. It used to be called PhoneHalo, it's called Tracker. It's like Tile's main arch rival. And they used crowdfunding masterfully. And Tracker does some OEM work with people like Samsonite, for example, to sell their products as well. And what they would do is they'd run a crowdfunding campaign for each new product and would demonstrate that there was a market for it. And then partners are like, well, there's clearly a market for it because you sold $500,000 worth of this stuff. We'll place an order. So having the ability to do that is really critical. Now, part of it is the way hardware crowdfunding campaigns go horribly wrong is if the people involved have not actually dealt with hardware before and dramatically underestimate the cost of delivery. This has sadly happened. But if you're experienced with hardware and you know that you actually have nailed the bill of materials and the manufacturing costs and things like that, it is a great way to sort of demonstrate that traction. And any investor is going to always say, if you have any kind of vaguely consumer-y hardware product, have you put it on Kickstarter yet? Have you done a crowdfunding campaign yet? Because if you haven't, why haven't you?
Gotcha. Okay.
All right, so I don't know who I turn this over to now to conclude. Should I turn it over to you, Roger? or-
Yeah, I mean, I think, really thank Chris for coming and speaking to us today.
Thank you.
Always great insight and, great practical in-the-weeds stuff, which is kind of what we're all about here. So,
Absolutely.
appreciate it, thank you.
No, it's always a privilege for me to come in and speak to people. As I described earlier, as investors, we have to find ways to stand out with entrepreneurs. And one of the things I do is I feel like if I go and I tell the truth to them, then they'll figure that if they're ever working with me in the future, I'll give it to them straight. Because if he'll tell it to perfect strangers on the internet, he'll surely be straight with me in private.
Thank you. Thank you.
So thank you very much. Wonderful journey you guys are on, and while the odds are always against any entrepreneur succeeding, I sincerely hope that all of you somehow buck the odds and succeed.
Awesome.
Thank you.
Chris, you have to dash out, right?
Sadly, yes, I have to go to a board meeting at 3. I apologize, but I have my various cards, get the book. Please do buy them, leave reviews. I should have mentioned that earlier. Reviews are really awesome for me.
That's right.
We have like 66 reviews or something like that, but the more the merrier. That bastard Ben Horowitz has like 200 reviews for his book, so I want more for mine.
Some of you
Yes.
came to event expecting to have lunch and didn't
I was
have
class of
lunch.
2000.
We bought additional 6 lunch.
So I've got business school.
Please feel free to take those.
But yes.
I just want to give you my card,
Yes.
maybe we can connect later. I'm one of the advisors.
Yes,
I
absolutely.
was a professor of linguistics and I do name development and I
Very cool.
advise at Stanford Business School and Altitude, I don't know if you know Ravi Malanda.
I do, absolutely.
Accelerator, I advise
Absolutely.
there. I advise here. So if you wanted to, I've always loved to give startups.
My pleasure. That sounds like a plan. I'm glad, and I'll leave business cards here, and I'll leave them here for other people as well, obviously.
Oh, do you have any?
Are they all gone already?
Yeah, you can take one.
Holy smokes!
Oh, I put
They went fast.
some of them over there.
Oh, okay, all right. Oh,
Funny as you're fun building girl.
I mean, she has.
okay, we'll quickly meet. Reach out to me. I will be reachable. And I apologize that this board meeting thing. That's good branding too. I like that. Fox is underappreciated because people can't misspell it. It's very short. That's right.
So now I just need to make
Hi, Nicole. Nice to meet you. That's why we want
I think I heard game.
when somebody here is
Awesome.
doing involving games, but.
Excellent. Brad Valentine, those are great books. I love them.
I think I'll email you.
Yeah, absolutely. Absolutely. Harry will connect.
I'll be down here.
And I left some business cards over there.
Because
I remember and I'm giving a gift card.
But I
Yeah, excellent. Well, hopefully you got something out of it.
Yeah, that'd be awesome.
No, I'm completely paranoid, but it's totally fine. I've already, we haven't signed it, I think. But we've done the angel list. So I've already added photos to the cover sheet and ordered it to my attorney. You know, I'm just always, it's just alarming for everyone. Like my conversation compensation is set at Foundry Group. And I actually raised the cap. And so, you know, and they're,
So what's they doing again?
we don't have it. We have it here. Our
Oh, because you were not in it.
I mean, if you look at the Series A numbers.
Yeah, so I have those numbers.
Differences
Right.
from the-
But I even had a couple people that actually could say,
Currently.
I would normally invest 50, but I'm not going to.
But after this class.
I just think it's worth it. I was like, whatever.
Yeah, you know,
One of those is actually.
at the end of the day, I mean, that's not the only place to raise money from.
That way we have a direct.
You know, maybe take it down. So,
I was
do the
thinking-
I'll be right
work.
there, but I started.
Well, it
Because
depends on
we
what
can
you
get far
do.
five.
And sort of.
Just,
flood that
you
in.
do an oversubscription right, so you give yourself the right.
The wiggle room.
So do maybe 4 with an oversubscription right of 350, or, 350 with an oversubscription right of 350. And then, because often what I do is I bake into my term sheet, I say, in the event that the company goes into its subscription right, you can increase the cap and decrease the percentage, the discount. Because it's de-risked, right? But, people, I just don't think really give it enough thought. That was my sort of message.
No, I get the message. It just sounds so excited. I do that. Like I
No,
feel like they're
that's
putting us
great.
on the map.
But that's fantastic. So how much are they putting in?
300.
Okay, so maybe,
So I have 375.
okay, so then you say that's at these terms, because they came in early and they came in large, and then it's uncapped or whatever.
Originally, like when I was doing friends and family,
And the
we were raising
only difference is.
350 to 500 as a capital, right? Apparently we were way out.
So there's just
Even then, but that was back in the spring. I've made a ton
really
of
important to
numbers.
just
So when I was,
And it's real friends and family, right?
it was then, yeah.
Right, so you don't really mind if they get a disproportionate share, because,
Right, no, I just.
you know, but you just don't want, like,
But never gives you
arbitrary.
insight into the conversation, because it's hard for me to know where else.
But I do believe that
So I met with
if
them
you are
before I
good,
left here, and I was like.
Oh, they
so
are,
now I'm
right, so
sure.
and you'll find the right people too, like.
Right,
And
but
then
building
I
a
gave
network
them
is
a
part
Colorado, and I
It
pitched
is.
there, and I had
It
some
is,
interest.
and the guys that are
just
like
things
on
started
Xanto
happening.
Row
And then he came in and said he wanted to do 300 to 50, and so then I was like,
We
we'll raise cap.
no, but it just for whatever reason.
So I told him like, that I wanted to raise the cap, and so he's like, well, you were willing to give up that much before, so why don't we raise it
I
to
just
this?
think that there's.
And then I said, and I'd like to leave it
Everything
open to
he
raise
said was
750.
so valuable, and I
And he
wish.
said,
I've done two,
so it's almost like,
Excellent.
he's like, do you think you can get there? And I was like, yeah, I think I can.
It's very
I'm interested.
clear and
Yeah.
So it's almost like he was
Very-
trying to keep
very
me at
complex
that
but yet simple.
ratio, because I, you know what I mean?
And
It seems kind of weird.
Tell me who you are and what you're up
Because
to.
now
So
I'm,
I'm one
I
of the
kind of want to
advisors.
stop
Oh,
it,
okay.
right? Because we're almost
So
out.
I was a
I'm
professor of
stop.
linguistics for many years at Harvard.
I don't want to get
And
shut
it's
down.
UC Berkeley.
pretty
and
expensive.
I wanted to leave academia.
So you think, yeah.
But I mean, at the 350, at the
So I was
3.5 million
Nodding
cap,
at, not the
it's really
right, not
expensive.
even.
So if you just change the term sheet,
Because
um, and say,
because I do need
yeah,
it
put in
now.
oversubscription,
But I was not even in a lot of.
say another 500,
things
give
we
yourself,
talked about.
give yourself flexibility,
Right.
up to
When I
million.
started previous
But the next 500 is uncapped and 20% discount.
Building my network, proof of concept.
So you got
how to get
400
portfolios.
at these crappy terms, and then the next 500 or 600 uncapped 20%. So
So this
if you
was,
need
and
money, you're not
here
going to be
because
beholden to
I
Seth
so
or
many
anyone else
startups
and go like, hat in hand saying, can we extend, can we do
having
this?
to direct them
You've got
toward,
that amount of money,
400 as is the next 500, no cap.
or 600, you give yourself up to a million, because then you just never know, but it's like a credit line almost, as you need, you can just draw it down, but if it's uncapped, and, I mean, my concern would be that you get the $1 million threshold, so anything that you do, really, any kind of next raise is gonna trigger a conversion.
So
And
far,
you just-
I'm
you
new.
don't want
I've
it to
given two
convert it
workshops.
quickly
I
for
gave,
the
like, a general talk
uncapped
on
money,
meeting
'cause
and then last
it's
time
more expensive, the longer it goes on, and the
brand
higher the
position,
value
and then
you
the third
Yeah.
one.
You
So
get.
it's.
So maybe
I
it's
guess it's
even
different. I
close this
advise
round at
also
400
that
and just have another offering
the school
that you start
and
once this one is closed at 400, and you can have it on decent terms.
I can always
Only by name,
close
not-
it at any
not-
time, right?
Very good.
Like once I raise it, that's why I think that we got really far.
So I do a lot of
last
one-on-one
October.
coaching.
and
So
so
it's been, I've done a little
And I
bit of
just
that
like shut
here.
this down.
But haven't had
Yeah.
to do because of the
I
way she
appreciate your insight.
Not a problem, not a problem. Pardon?
Planners are now in a good place.
Yeah, it's
So
just,
it's a little bit different from
Yeah.
Only,
And I'm not
Pardon?
sure,
I'm doing paralegal work.
I've actually got it right, I've got it stapled.
I'm still trying to get a sense of what stage they started.
We agreed there was no cap language in here last night, so I just wrote my own cap language.
Yeah.
Um,
And I live here.
Do I need to be more specific?
Needs to be the big.
um,
So here it's a mixture.
I mentioned
Yeah,
night seed,
um,
compensation and fees paid around the
So those folks, I think the folks that are at Alchemist had maybe been entrepreneurs, a lot of people have been entrepreneurs before, and this is the second time around.
So I just scratch the
Yeah,
last
scratch
part.
that part.
And then,
Just,
does it have to be a 5.1, 5.2, or can I just lump that at the
Yeah,
end of
just
it?
notwithstanding anything contained to the contrary, in no event
And.
shall.
Okay, in no event shall, but I don't need to make a 5.1, I can just add. I'm trying to make it simple for you, man.
You are. You are.
Is doing.
Yeah, one day I'll go to law school or something. Did you ever talk to Crystal? She's still,
Since I was a.
she's